All right, it's time now for Hot Picks. We speak to an investing professional about 3 stocks that they have the highest conviction on. Today, we're focused on the healthcare sector. Rob Moffat is portfolio manager at Middlefield Group. He's got 3 picks for us. Thanks so much for being with us. But let's talk broadly about healthcare. I know everybody says aging population and all that, but you also have to be mindful of the current market dynamics. Is healthcare in because you're defensive, or is it out because it's risk on? So how are you thinking about healthcare right now, kind of located in that macro story?
Yeah, so I think the sector broadly is very well positioned in this environment, primarily on the demand side. So healthcare companies typically sell needs-based products, which have inelastic demand. And then in addition to that, when healthcare products are consumed, it's often paid for by an insurance company or by the government. It doesn't really factor into their discretionary purchasing decisions. So from a demand perspective and from an earnings perspective, I really think that healthcare makes a lot of sense in this current environment.
Okay, and it might be tough. You might be feeling like you have to chase some of these names higher, but all of your picks today did not really participate in the healthcare rally, so you have an opportunity to potentially buy them on the dips. Abbott Labs is the first one, and it's down, what is it, down something like 20%?
It was about 21%.
Yeah, 21% over the past year. What do you like about it here, and why is now the right time to buy?
Yeah, so Abbott is a large cap diversified MedTech company. First, I'll say I really like the MedTech sector broadly. Okay. If you look back, there's a good stat from Goldman Sachs that came out recently that shows over the past 60 years, MedTech has outperformed the S&P by more than any subsector in the entire market in periods when inflation is high and starting to come down. So we're clearly in that environment right now where we had high inflation. I believe it's peaked and it's going to gradually come down. So MedTech really makes a lot of sense.
I think a lot of people are focused on, biotech, and they understand the dynamics there. M&A is a part of it, but you're getting new, drugs through the pipeline. What do you think? What are the kind of main thesis around MedTech, and what are typical catalysts? Yeah,
so really MedTech, what I mean by that is equipment, devices, and tools often used in a hospital, but they can be used in other settings. And a lot of the headwinds and the reason that names like Abbott were down 20% last year had to do with macro issues like inflation, supply chain disruptions, labor shortages were a huge issue as well. So, those, I believe, we're in a position where last year's headwinds are turning into tailwinds.
So Edward Life Sciences is another MedTech name, and it focuses mainly on the cardiovascular instruments for cardiovascular. Also, that's one that has even underperformed Abbott. Why the underperformance, and why do you like it here?
Yeah, so Edwards was down, to your point, about 42% last year. Coming into the pandemic, this was a darling stock. It traded at a big premium to its peer group. And the reason for that is that it's positioned in a dominant position in the TAVR field, which, without getting too technical, TAVR is transcatheter aortic valve replacements to treat aortic stenosis. Yeah. So it's a very common heart condition. It affects about 1 in 8 people over the age of 75. And it's not immediately life-threatening, but if it goes untreated, then you could have serious adverse events like cardiac arrest, atrial fibrillation.
And is it because it's not immediate, is that why the stock is down? Because treatments in hospitals, a lot of them were being pushed because of the pandemic, the immediate needs of the pandemic? Yeah,
I would say the stock is down because, naturally with the pandemic, elective surgery procedures fell off a cliff. People couldn't really go into the hospital. Resources were directed elsewhere. And then I think investors were hoping to see a return to growth. I mean, TAVR procedures were growing over 20% per year prior to the pandemic. And then we didn't really see that manifest in 2022. And probably the biggest reason for that has to do with labor. It was really hard for hospitals and surgery rooms to staff their facilities to get these procedures through the door. And it's not just skilled nurses and heart surgeons, but it's also cleaning staff and people that you need to operate a hospital. So labor's been a challenge. Edwards has called that out as being a headwind, but I do think that dynamic is improving, and we should hopefully see a return to double-digit growth for
It sounds like you have to be patient. You're not it doesn't sound like you're super confident we're going to see a return, but you're hopeful we will. And maybe it's a multi-year story.
Yeah, I think that, 2023 will be really a test. Edwards hosted their Investor Day in December where they basically reaffirmed their long-term targets. They see the TAVR market growing from about $5 billion today to $10 billion over the next 5 years. So they have about 75% market share in this field. If they can maintain that share and participate in the industry growth, then yeah, I mean, it is a bit of a multi-year story, but at this level where it's trading and given the growth outlook, I think it's a really good time to.
So your third pick, Chartwell Retirement Residences, would also be part of this. They had to deal with a lot during COVID, and are they getting back to business, full occupancy? Post-COVID, labor shortages, all of that. Does it parallel some of the other stocks that you're seeing out there?
Yeah, from a labor perspective, it certainly does parallel a lot of those dynamics. Chartwell, similar to hospitals, had to go, there was a lot of absenteeism during the pandemic. A lot of people weren't showing up for work. There's a lot of turnover. So they had to rely on agency labor, which is basically third-party companies that provide labor for a premium price. And it really inflated their expenses and squeezed their margins. So that dynamic, I think, is improving. For Chartwell specifically in Canada, having 500,000 people come into the country every year over the next 3 years is certainly going to help that labor pool, and that should help ease some of those pressures. So I am optimistic that the worst is behind us for labor.
And on pre-pandemic occupancy, do you think it's a this year story?
This is probably a story for a patient investor where coming into the pandemic, occupancy was about 90%. Fast forward to the summer of 21, 18 months later, it bottomed around 76%. And then last year in 22, what we saw was a lot of its peer group, Sienna is probably the closest comp. They've had their occupancy rebound by about 10%, whereas Chartwell's still only about 2% off the low. So it's really kind of gone sideways over the last year. And it is for a patient investor, but I do think that we're at an inflection point for the occupancy level. We just saw management at an investor conference last week talking about their marketing strategy. We were really encouraged by some of the initiatives they're taking there. So I do think that the occupancy is not going to come back overnight, but it should be gradual and consistent over the next couple of years, and should see some really good earnings growth from that.
Rob, thanks so much for joining us for today's Hot Picks. That's Rob Moffat, Portfolio Manager at Middlefield Group.